Good afternoon. Welcome to the January edition in our supply chain management webinar series. Few housekeeping things before we get started. If you have a question during the webinar, on your control panel, raise your hand. I will try to answer questions as they come along. If not, I will hang around after the webinar ends to answer any and all questions. And if you would like to see a repeat of this webinar or any of our previous webinars, you can go to the webinar page on our website where we have a library of our past webinars. Okay, let's get started today. We're going to be talking about inventory valuation methods. What we're going to look at are the purpose and uses of inventory valuation, some of the types of inventory valuation methods, and then we're going to look at a few of these inventory valuation methods and the impact that they have on our cost of goods. So, inventory from an accounting perspective is looked at as a short-term asset in comparison to like a building or a piece of equipment that is a long-term asset. To put this in context in our personal lives, if you own a home, that house is a long-term asset. You've put a down payment on it, you have a mortgage on it for 20 or 30 years, you're expecting to live in that house for a considerable period of time. On the other hand, in our personal life, that gallon of milk in the refrigerator is a short-term asset. And if you have lived in a family with teenage boys, as I did several years ago, teenage boys can go through a gallon of milk between 7 o'clock in the morning and 3 o'clock in the afternoon. So it is really a short-term asset. In business, in manufacturing, our inventory is a short-term asset. That inventory consists of raw material, work in process, finished goods inventory, all short-term assets. Now, the purpose of valuing that asset is to know where we stand. It serves several uses. One of the uses is that it is one of our assets, and the IRS loves to know what all our assets are so that they can tax businesses accordingly. However, one of the more fundamental uses for inventory valuation in any business is in the cost of goods sold calculation. Cost of goods is material, labor, and overhead. Now, how we value our inventory allows us to understand when we sell a product, are we selling it for more than it cost us to produce and our general and administrative expenses? Or inventory valuation can tell us whether we're losing money when we sell a product. These are key measurements that we need to be able to successfully run a business. So that covers the purpose and uses of inventory valuation. Now, let's take a look at several types of inventory valuations. This is not an all-inclusive list. There are many different inventory valuation methods and they serve different purposes. We're just going to look at a handful of them now. First method for valuing our inventory is actual. Actual tends to be used when you're doing a project and you want to be able to charge exactly what you paid for the raw material and the sub-assemblies and that you used in the manufacturing of that project. This is a one-time thing that you're doing. So in this example here, the actual price for these bolts and washers is $3.26. That would be the price that gets charged to the project that we're working on. That's the inventory valuation method that we would use in project manufacturing environments. Another method, average inventory valuation. So let's go to the supermarket for this example. Oranges. Let's say this supermarket buys oranges in lots of 50. When they purchased this lot of 50 oranges that you see on the screen, they purchased them at $1 a piece. Now, they open the door, people come in, they buy oranges. Let's say during this day, people buy 20 of those oranges. They have another resupply of oranges, only this time they paid $1.05 for each orange. The way average works is they would take the number of oranges at $1 a piece that are remaining, in this example 30, multiply 30 times $1. Then they would take the new resupply order, 50 at $1.03, and come up with that total cost. They would add the two totals together and then divide that number by the 80 oranges that they had in inventory. Now, the interesting thing about average, as soon as the first customer comes in and takes the first orange, that average cost has to be recalculated again, because now we only have 29 at $1 and the remaining 50 are at $1.03. That's how average works. Still in the supermarket. First in, first out. We've all been here. Long checkout line. The guy on the right-hand side of the screen, he is the first one in line. He's the first one that gets checked out. Same concept happens when you're using first out in inventory valuation. Now, the flip side of first in, first out is last in, first out. It stands it on its head. So, yeah, the picture's upside down. The point is, the guy on the right-hand side with the shopping cart, he was the last one in line. He's the first one that gets checked out. I want to stress that first in, first out, last in, first out is an accounting way of dealing with inventory. It doesn't mean that we have to issue the actual material that way. It's just how accounting would cost out the inventory. The last method we're going to look at, excuse me, is standard cost. Now, I spent 25 years in electronics manufacturing. All the businesses that I worked at, we used standard to cost out things like these integrated circuits. The way that standard works, at the beginning of the fiscal year, we determine what the standard cost is going to be for each item that we carry in inventory. In this example, we determined that each integrated circuit, each one of these integrated circuits is $1.23 a piece. How we come up with that standard, you can use a variety of techniques. You can use past history. You can do quotations from your suppliers for what you think you're going to be buying in the coming year in the standard quantities you buy them in. However you determine it, you set the standard at the beginning of the fiscal year. Then, excuse me, as transactions happen, if purchasing buys this material and they're able to buy it at $1.20, the incoming transaction into inventory is done at $1.23 a piece. However, there is a good variance of -3 cents a piece on each item received, and that is booked to a variance account. On the flip side, the next time purchasing buys this material, if they have to pay $1.25 a piece, the transaction receiving them into inventory is at $1.23, and a bad variance is booked to the variance account for that additional 2 cents we had to pay for each item. So those are some of the types of inventory valuations that are commonly used in manufacturing environments. Now, let's take a look at how some of these inventory valuation methods impact the cost of goods sold. Let's go to FIFO. Remember, the line of people waiting to get checked out at the supermarket. In FIFO, it assumes that the oldest item in inventory is the first one used. Now, in a period of increasing cost, this keeps the total inventory valuation on the balance sheet close to the current market value of the inventory. However, because we're using the oldest inventory first and therefore the lowest cost first, it tends to understate our cost of goods sold. Now, that's FIFO. Look at what happens with LIFO. With LIFO, it stands it on its head. LIFO assumes that the newest items in inventory are the first ones issued. Again, in a period of increasing cost, what this does is it tends to understate the total value of your inventory on the balance sheet. However, what it does do is it keeps the cost of goods sold close to the current market cost. Now, years ago, I had one client, EB Corporation in Philadelphia, Pennsylvania, who made electrical contacts for the electronics industry. And the biggest thing they had in inventory was gold, because all of the contacts had to be plated with gold. In this environment, they use LIFO because in the period where the price of gold is going up and up and up, and in fact, in the year or two that I worked with them, we saw the price of gold go from $800 an ounce to over $1,100 an ounce. In this type of environment, they needed to be costing out the products that they were manufacturing using the latest gold price possible, because if they didn't, it could literally drive them into bankruptcy. One final way, standard. Now, with standard cost, remember we determined the standard cost for each item in inventory at the beginning of the fiscal year. All transactions are done at that standard cost. Its impact on inventory valuation, it keeps the inventory valuation pretty close to what the actual market value is. Because if we wanted to see our total inventory valuation, we would just run a report that says, okay, here's our inventory at standard. And then we would look at the variance account where we keep all of those good and bad variances as a running total, and we would add or subtract that amount of money from the inventory valuation. So the inventory valuation would be pretty close to what the actual value of it is in the marketplace at any given time. And the nice thing about it is that same methodology can be used to determine your cost of goods sold for any particular product just by looking at the standard cost of the items and the variances that we have booked over the course of time against that. So in this situation here, and this is what we used in electronics predominantly, using standard cost kept our inventory valuation close to market value and kept our cost of goods sold close to market value at all times. Which valuation method is used by any company is usually determined by the type of product that you're manufacturing, the type of market that you're in, and various things like, are we in an increasing cost market or a decreasing cost market? So that's it. Inventory valuation methods.